Hey, welcome back. It's John from accountingplay.com. If you haven't already, go subscribe below and ask me some questions. Today, we're studying debits and credits. I understand my handwriting's not that good. That's why I have this lovely ebook, Learn debitsandcredits.com. Also a premium video course, so less little product pitches that I love to throw in here. So right now it's free. Otherwise, if not, email me, john@accountingplay.com, because it probably won't be free by the time you look for it. But if you email me, I'll hook you up anyway. Just go ahead and do that. Also, the game. Hit me up for that. Now, without further ado, let's get right into it. What are we talking about today? We're talking about assets. We're talking about T accounts. T accounts are a thing in accounting. You already know it. There's a debit and a credit. And it explains where the money's going, what's happening here. All right? So, let me go ahead and grab a pen. Back right here. For every transaction, there's a debit and a credit. Here, we're focusing strictly on assets, which will also help us focus on the general functionality of the T accounts. Assets increase with a debit, decrease with a credit. Assets increase with a credit, decrease with a credit. So I have cash 1 and cash 2. So a very big business, they're going to have like 100 checking accounts, right? In this case, we're just 2. So you can transfer between asset accounts, and I'm using this example so we don't have to think about the nature of the transaction, where it came from, these other more complicated journal entries / T accounts. So let's say we are going to transfer from account 1 to account 2. Let's increase the cash here. So increase cash with a debit, 100,000, because we mean business here at Accounting Play. Now, we only have one other account, debits equal credits. This here is an increase with a debit. This is a reduction with a credit. Reducing with a credit. Down. Very convoluted, right? Let's do it again. Increase cash down here with the transfer. Debit cash up. Credit down. There we go. 50. So in this case, cash has been reduced 150,000 down. Cash here has increased by 150,000. Now, the one thing that I didn't do is that there was no beginning balance in this cash account. So where did the cash come from? So let's go ahead, just for simplicity, put a beginning balance here of 500,000. So we're assuming that that was already there at the beginning. So how did this work? Think about like your bank. It went from 500,000, dropped 100,000, dropped 50,000, and where did the money go? Down here. How did it go and flow in the accounting system? Debit cash up, credit down. Debit cash up, credit down. So now, at this point in time, no cash increases in this cash 1 account. So here we have 500,000. And we also have 150 out. So we don't keep a balance on both sides, we subtract. So 500 minus 150, pressure's on, $350,000 remaining in this account, and 150,000 in here. Debit cash up, credit down. For liabilities and equity, flip it around. Debit cash up, credit down. Liabilities and equity, flip it round. Debit side, credit side. Debits, credits, debits, credits. This has been Assets. Thank you.